International sales at McDonald's restaurants fell short of expectations. And while the U.S. was a bright spot, it did dent overall growth prospects. Now, initially, the stock flinched. It was down some 3% in the pre-market, but now it's up nearly 1%. This is the company is grappling with the E. coli fallout that is not yet reflected in the quarter. The company did speak to that and said that they don't think it's going to be material to its business going forward. While the stock is still under pressure relative to when that news first came out, you can see that on the very right of the chart. Let's bring in Peter Saleh, Managing Director and Restaurant Analyst at BTIG. Peter, thanks so much for joining me. So from when the results came out this morning to now, what has investors kind of incrementally positive here?
Yeah, so thanks for having me on. I would say there's a little bit of a relief rally going on right now. I mean, it's up a little bit more than 1%. It's a relief that the E. coli issue seems to be contained to a certain number of states, and they figured out where the issue is, and the impact is probably, the worst is probably behind them, and not much of an impact to fourth quarter and likely not into 2025 either. So they did indicate that same-store sales in October, on the heels of the Chicken Big Mac promotion, was running up mid-single digit, which was a very nice, healthy acceleration from where they were in the third quarter with positive traffic. Again, much better than the third quarter, but then that stalled on the E. coli issue, and traffic and same-store sales both moved negative in that last week. So in our view, I think a little bit of a relief rally. I think investors are kind of looking through some of this food safety issue, at least in the near term.
The question is, would you pick up the stock here? Because even with all those issues, there's no denying sales at McDonald's are decelerating.
Yeah, so look, we remain neutral on the shares. We've been neutral the vast majority of this year. We just think this is an environment where all the quick service operators are discounting, not just here in the U.S., but overseas as well. It does put pressure on margins. It does put pressure on sales. Look, they're doing their best to get consumers back into the restaurants, but they had a lot of discounting in 3Q, and traffic was still negative. So some of these are fleeting promotions that come in and out until we see a real, true national value platform that resonates with consumers and is permanent part of the menu. It's tough to be too excited about what the prospects for earnings growth is going to be over the coming years. So we remain on the sidelines for McDonald's.
So they are touting value. They've rolled out that $5 value menu, and on the conference call they mentioned how, you know, those that are buying that $5 value menu tend to come to McDonald's more. Why, you know, and it sounds like that's a step in the right direction in your perspective, but you're not quite there and ready to say that's a reason to buy.
Yeah, look, we see it as still a battle for market share here, a battle for traffic with McDonald's and all the other QSR operators. Consumers seem able and willing to spend on certain menu innovations and deep value. That they're coming out for that. However, it's not consistent enough in our view. It's not an underlying trend that we see as consistent going into 2025. So we'll wait to see more details on their national value platform, which they said will come out in the first quarter. That should give us a little bit more confidence, hopefully, in the story, but still yet to be determined how aggressive they're going to be on the national value platform come 2025.
There are some turnaround stories that you are willing to buy. Starbucks is one of them, which of course is a new star CEO from Chipotle. It has held on to the stock market gains it's made since the appointment of Brian Niccol, but results really showed that they've got their work cut out for them.
Yeah, look, I think Starbucks has a lot of work to do. Yeah, you just saw one of the poorest quarters in terms of fundamentals that they've put up in a very long time, excluding the pandemic, in terms of same-store sales in both the U.S. and international and traffic, being negative. That said, I think this is the first time in Starbucks history that they have an external CEO with restaurant operating experience coming in with a fresh set of eyes, and will bring in new leadership to help bend the curve here on same-store sales and traffic. We also think they're going to lean on marketing. They've already started to do that. We think they might lean a little bit more in terms of backfilling or infilling some of the unit closures that they had right after the pandemic as they shifted from more urban stores to suburban stores. I think they may have to go back and re-infill some of those urban markets to recapture some of those incremental sales. So I think they have a lot to do, but we're pretty confident that Brian's the man to do it.
And still you want to be invested in Chipotle, which is, the shop that he left. It's been slowly drifting higher, but there's still a little bit to capture from its recent high. You're not fussed by the strategy and the direction that Chipotle will be taking without Brian Niccol?
So my sense is not much will change. The strategy that he put in place was pretty significant on advertising. It was pretty meaningful on terms of their digital availability, in terms of having a digital app and loyalty, and developing more drive-through locations. I don't think all those three pillars are going to change going forward. I think on the call this evening, I think investors will be interested to hear if Scott has anything that he wants to change. Given that he's not the permanent CEO yet, our sense is he probably won't tell you too much in terms of what, if anything, he will change going forward. But I think investors should be listening for their availability of labor and how well staffed they are. One of the key drivers for growth for Chipotle in terms of same-store sales is throughput, but they have to be fully staffed for that. They have to have that expediter in place. As of last quarter, they were only about 50% of their restaurants have that. They probably want to get to 70%, maybe a little bit higher. So I think that's one of the key focuses for us going into this call, is how well staffed are they and how fast is throughput going through those stores.